Is your mortgage tax deductible? Last time we looked at Sandy Aitken's tax-deductible mortgage plan to show how homeowners can have their cake and eat it too when it comes to paying down a mortgage and building wealth for retirement. But of course, we have rising interest rates threatening and enormous stock market volatility. So we're going to have Sandy back today to talk about, well, first of all, Sandy, you founded this in 2006, correct?
That's right.
And therefore, your clients went through the stock market crash of 2008. What was the experience?
Well, that's a great question. Without a doubt, the last 2 years have been tumultuous, and for leveraged investors, for those that are in the market or even non-leveraged investments, it's been a rough time in the equity markets. What I can tell you is, if you're a leveraged investor and you're using your home to invest, for our portfolio of clients, of clients is intact. And by that, I mean we had 0 defaults in the mortgage, and all our clients are in a long-term plan, meaning they're in a plan for 10 to 15 years to get ahead of the game and reinvest their tax benefits. And certainly timing of the market was of essence. Some did really well if they got in at the bottom of the market, and some who got in before the market crashed are still waiting to recover their investment back to the original position. But the key to a strategy like this is cash flow. And the fact is, clients that got in 2006 were borrowing money at 6% at prime, when prime was 5.75 or 6%. Then when the market crashed, they may not have had as much cash flow from their investments, but they're now borrowing the same money at 2%, right? So the key with a leverage investment play is that the cash flow from your investments has to cover your debt obligations. And as long as monetary policy in Canada has interest rates falling when the market's falling, if they track each other, then the plan works very well. The risk is, if you ever believed that interest rates were going to soar when the market was at the bottom, then there would be a cash flow consideration, which means that you would need to know that you have other sources of cash flow to cover a plan in that eventuality.
Let's go through an example, Sandy. Let's say, I don't know, a Toronto home would be $500,000, so you have a mortgage of, let's say, what, $400,000?
Right. Well, if you've got a mortgage of $400,000 on a home worth $500,000, you're right at the very top of conventional lending, because above 80%, you're then high ratio, you're an insured mortgage. So for the tax-deductible mortgage plan, you still have to wait. If you're high ratio, if you've borrowed $400,000 or more to buy a $500,000 home, you have to wait. And typically after 5 or 10 years, that home's going to be worth $600,000 or $700,000, and your mortgage is down to $300,000. That is the point where you might consider a tax-deductible mortgage plan where you borrow back up to the 80% and you make an investment that spits out tax-efficient cash flow and allows you to prepay your mortgage and borrow it back and invest.
So you're building a non-registered stock portfolio. So on that same example of the $400,000 mortgage, How fast are your non-registered assets rising from 0 to how much in how much time?
So those in that example that we just used, you would be able to build $1 million portfolio of non-registered assets over 20 to 25 years. And that happens, so that does happen over the period of time where you could just be paying off your mortgage to have 0 at the end of it, or you could have $1 million at the end of it, assuming a reasonable rate of return between 6 and 8%. And assuming the rate of return is slightly higher than your cost of borrowing.
Is it all non-registered? Would you not be pumping some of it back into your RSP, maximizing that, taking the refund, and maximizing the tax-free savings account as well? Or is it for some reason stay non-registered?
It has to be non-registered. That's a tax rule. So the whole idea of the tax-deductible mortgage plan is it's the mortgage part of your portfolio. What you do in your registered plans, you're already getting a break from, and you can't employ them. So you've got your registered plans separate from your tax-deductible mortgage plan. And I would say that if you can suffer the anxiety of being an investor in the market, if you're not the type of person that's going to watch the market every day when you're in a 15-year plan, then the tax-deductible mortgage plan is good for you, because the only other real problem, the biggest issue that homeowners have in this strategy is discipline. If you're managing it yourself, you have to go to the bank at the same day every month to prepay your mortgage and then again re-advance after the prepayment clears, it's 2 or 3 visits to the bank every month. Under the tax-deductible mortgage plan, it's automated. It's why many financial advisors and mortgage brokers use it, and they just send their clients to www.tdmp.com to take the test to find out if they qualify.
Well, we're closing it up now. I was about to ask you what your website is. You saved me the bother. Thanks very much, Sandy Aitken of the Tax Deductible Mortgage Plan.
Thanks, Jonathan.